Thanks everyone for joining us. Today we'll have Layne Walters talk about how to make your primary residence mortgage tax deductible. And then I'll hand it off to Layne.
Thank you, Anthony. So yeah, as Anthony was saying, we always give the advice of, when we're giving presentations, it is for information purpose only, meaning that even though we're, realtors, mortgage brokers, the advice we're giving isn't necessarily specific to you. So it's an overall indication. We might, tell people in here that, you shouldn't buy condos as an investment. And the way that would kind of show up is I generally don't like condos as investments. A lot of people come to me and say, oh, my best investment property is my condo. It's the first property I bought. Then dig in a little more detail. Well, when did you buy it? Oh, 2003. How much do you owe on that condo? $32,000. So how much is it worth? $400,000. Well, of course, you've got $30,000 on a $400,000 investment. You've got, over $350,000 of equity tied up in your investment. Of course, it's going to cash flow really well. So you think it's a good investment, but it's actually not. You could sell that property, buy a single family home, put a $300,000 mortgage on it, have main floor plus basement suite plus garage, and make far more cash flow off that, plus own 4 times as much value of land that's appreciating. Right now, on the other side of that, you might have a condo that is $30,000 underwater. So it's worth $370,000, but you owe $400,000 on it. So it actually cost you $30,000 to sell. So in that scenario, maybe you're breaking even cash flow wise. Maybe you're losing $100 a month, but then you have $500 a month in principal pay down. So you're paying down $6,000 or $6,000 a year. It's costing you $100 a month. So you're basically making $5,000 a year on it, and it would cost you $30,000 to sell it. So it's not a good investment, but it's too late. You're already in it. It would cost you money to sell. You might as well just ride it out. Right. But even that scenario, so I'm basically saying to one person, you have really good cash flow in your condo, you should sell it. The other person, I'm saying, it's not cash flow at all. You're losing money, but you should keep it, right? So that's how the general advice we might give as condos aren't good investments would apply differently to different circumstances. So there's even further we can go down that rabbit hole of if it's inhibiting your ability to qualify, you got to sell it anyways, but not if it uses up all your down payment. So there's a whole bunch of different scenarios. That's the general advice we always give. It's even more important today because I'm talking about, I am a licensed mortgage broker, but I'm not an accountant, not a tax specialist. I have no certification in any of that. I have a general understanding of more tax deductibility from my own experience as a real estate investor. And that's what I'll be talking about. But what I'm speaking tonight, I just want to be extra sure that don't take any action based on anything that I'm saying, even if it sounds like I'm really certain about what I'm saying. Make sure that when you're actually filing your taxes, you do it with a tax planner that has a certification for it, or a CPA, an accountant. So tax deductible mortgage interest. So the most Canadian homeowners, either now or at some point in their life, are going to be in a position to write off all or some of the interest on their principal residence mortgage. But most people just won't do it. They just don't understand it. Nobody explains that to them. The average person that doesn't have a big business and is having even if it is a CPA that files their accounting, your accountant is busy, it's tax season. They're just trying to get your taxes done, get them done properly. They're not necessarily giving you tax advice. So if you ask them about it, they'll answer your questions, but they're not necessarily going to go out of their way thinking, hey, could we reconstruct your mortgage or your finances in a way that give you a better tax benefit. They'll talk about individual deductions with you, but usually even a CPA isn't necessarily going to take the time, unless you're really specifically asking them to give you tax advice. So this is just something that we need to understand so that we can ask our accountants about it. So in the tax savings on a principal residence mortgage, it ends up being an awful lot of interest that you pay over your lifetime. So if you have a $500,000 mortgage and the interest rate is 4%, just for easy math, you're paying $20,000 a year in interest. So that's every single year. Now that's, that offsets rent, because now you're paying it on your mortgage. So it's not necessarily a bad thing, but it is an awful lot of interest. So with $20,000, if you convert that over to tax deductible interest, and your marginal tax rate is 40%, which is a reasonable estimate for an average couple, say, earning in Canada. So if you have $20,000 a year in interest and a marginal tax rate of 40%, that's $8,000 in savings just because you've converted your principal residence interest over to tax-deductible interest. So because that's after tax in your pocket income, it's equivalent to getting a bonus of $13,300 per year. And that's every year, that's not one time. So this is something I'm gonna kind of repeat because I think people kind of grasp it, then they're a little overwhelmed with the details of how to process it. And really what I want to drill in is that it's worth putting the energy into finding out about this because the savings is pretty significant. If your boss was to give you a $13,300 raise, or if you're self-employed and you've got a contract from a company you work with, and they said you've got to work a half Saturday every quarter, and I'll give you a $13,000 bonus in order to do that. So most of you would say, yeah, I'll take that bonus. And truthfully, it's not going to be on Saturday. It's going to be whenever you feel like it, whenever you have time to kind of put your paperwork together. It's going to be maybe once a quarter, every couple of months. You're going to want to kind of make sure you organize your taxes properly, but you have to do that anyways for your taxes. The biggest issue is you got to spend a little bit of time understanding it and then setting up your mortgage and the rest of your finances in a way where you can track all of it properly, but it's not actually all that complex. You're already doing your taxes. Just having a level of understanding is going to help you do this so that you can use these processes when your existing investments come up as they already come up. There are a few strategies that we are going to go over. First thing I'm going to say is, pay your taxes, don't cheat. Revenue Canada will catch up to you. I've seen people do a lot of cheating over the years. I get to see people's taxes. They might not tell their friends and neighbors about it, but I see what they go through. When people try to cheat on their taxes, overinflate expenses, they will get caught, and then it inhibits their ability to qualify for mortgages, and then it also costs them significantly more than they would have potentially saved. You can advocate for lower tax, even if you hate the government, you think they waste money. I do. You can advocate for lower taxes, but you still have to pay them. It's not an excuse not to pay them, and they'll catch you. However, you should pay your taxes, but it is not Revenue Canada's job to make sure that you're taking advantage of all your deductions. If you file your taxes on a rental property you purchased and you don't write off your interest, Revenue Canada is not going to call you and say, hey, I think that you forgot to write off some interest. Here's your tax refund. That's your job to make sure that you understand the tax laws as they exist and that you're taking advantage of the system as it's set up to encourage people to invest and pay their taxes fairly. So here's what not to do. Don't fall for tax schemes. Anybody in here ever heard of the charitable tax gift initiative stuff? One person or two people? Three. Yeah, I've done it, fallen for it when I was young. I had a mentor convince me to do it. Turned out not to really be a mentor, but the reality, you give $10,000 to go buy some drugs for malaria, send them to Africa, they reevaluate them as $50,000, so you get a $50,000 tax refund. You have to pay a capital gain on the 40 gain, but that's taxed at half the rate as your income, so there's a big tax benefit to doing it. Well, the government doesn't like that. It's not actually allowed. Don't fall for that kind of stuff. If it sounds too good to be true, it probably is, no matter how many details they give you and how many justifications they give you. Try to avoid those things because that haunted me for 10 years. The laws are even more strict around it now. So it will end up costing you not just double, like triple or quadruple, or inhibit your ability to actually finance anything for years while you fight in court, trying to get rid of the debt that Revenue Canada says that you owe them, which is, it's usually double or triple what you're actually owed. I'll get into the basics of how it works. So if you have a $500,000 mortgage and you have $500,000 worth of investments, maybe that's stocks, maybe that's rental properties, the equity part of your rental properties, maybe it's business, it doesn't matter what it is, as long as it's non-registered, like you can't use RSPs. But if you have $500,000 worth of investments and you have a $500,000 mortgage, then in theory, the only reason you have a mortgage is because you have investments. So if you sold those investments, you wouldn't have a mortgage. So therefore, you should be able to write off your whole mortgage, right? And that technically kind of sounds fair. However, maybe you only put $100,000 into investments and it went up to 500 and you could sell it, but you're not selling it. So Revenue Canada does not go on what ifs or I could do X and then it would be this. They don't do what ifs or could do this with the money or I could have done this with the money. They go on the purpose and the paper trail, and I'll mention those terms a few other times. So you should be able to write that off, but it is the paper trail and what did you use the money for? So it doesn't matter. You have to actually, if you want to make your mortgage tax deductible, you have to make sure you line everything up so that you borrow the money and it goes to the investment. Now we'll walk through a few different ways on how to do that. A couple of strategies. Strategy one, this is the one that I talk about the most. It's really just, there's no maneuver. It's not called anything. I could call it the Walters maneuver, I guess, but that it's pretending that I'm taking credit for the tax system as it exists. It's really just understanding taxes, understanding what Revenue Canada considers tax deductible interest or a tax deductible investment. And then making sure you have the right mortgage product so that you can fluidly do that as you make your existing investments. This one requires you to change nothing about what you invest. You don't borrow more money on the mortgage than you otherwise would. You don't invest in investments that you wouldn't otherwise be making. That's why I like this way. You just structure your mortgage. So investment decisions you're already going to make, you just make sure you line it up with a proper mortgage product so that you can track it and write it off really easily. The Smith maneuver, most people have heard of that. There is, I'm not going to get into too much detail on all of it. Again, I'm not an accountant. I'm not going to track your monthly transactions. I don't have software for that. A lot of people will offer you that. I'm not a big fan of this particular one, but it is a legitimate strategy that's been around for a long time, and it is legal if done properly. Cash damming. This is more popular. Has anyone here heard of cash damming? It's become very popular in the last 6 to 12 months. So I'll go over that. That one I'm a little more iffy on. I actually set out to go do a presentation on this, on how it's illegal and you should avoid doing it, but I actually could not. I could not find a way to make it legal. I would consider it kind of immoral and it violates the principle of the tax code, but I actually can't find a way to confirm that it's illegal. I think it's actually legal, but I'll go over into why I still don't like it. So what makes a mortgage tax deductible? So this is how most people understand it. Mortgage on your rental property is tax deductible because it's a business purpose. You bought a property and you put a mortgage on there. So the interest on that is tax deductible. You can write it off against the income of the property or even your own personal income. And then of course the mortgage on your principal residence is not tax deductible. So that's how most people understand it. Because 95% of the time that's true, but those two statements are not true. That is not how it works. Revenue Canada has no care at all where you register, where the bank has security of a loan. So this is correct 95% of the time because usually a mortgage on a rental property was put there because you bought a rental property. That's a tax deductible use. Usually you buy a principal residence, you put a mortgage on it, and that's a personal use. So that's why 95% of the time is correct, but it doesn't make these statements accurate. All that matters to Revenue Canada is what's the purpose of the loan and where's the paper trail. So purpose and paper trail, those are the two things that Revenue Canada cares about. You can secure it with your principal residence mortgage, your rental property mortgage, 1,000 head of cattle if you want. It does not matter to Revenue Canada at all. If you've got a loan, you're paying interest on it, and you want to write it off, what did you use that for? Where did the money go from the loan account, and where did you put it? And is that a tax deductible use? That's all that Revenue Canada discusses. So that's, basically, so purpose and paper trail. Just remember those things when you're thinking about it. Try and get out of your head the principal residence versus rental property in terms of tax deductibility. Even though, again, it's correct, which makes it so misunderstood because it's usually correct. I've had people call me and say, well, here's what I want to do. I want to, especially lately, because anyone who's owned rental properties over the last number of years, they've finally had the properties go up in value. So they say, hey, I want to refinance my rental properties, pull 200 grand in equity out of each of them, and then I can pay off the 400 grand I owe my principal, so that I'm moving all my principal residence mortgage that's not tax deductible to tax deductible interest, right? And based on those 2 bullet points, you can do that, except that that's not true. You get that extra 400,000 they're borrowing on those 2 properties, you're using it for a personal use, which is paying off another personal loan that you bought the house with. So that is not tax deductible. So the first thing you need to do to employ any of these types of strategies is have the proper mortgage product. So a re-advanceable mortgage. So most lenders have some version of this. The best in the market is still Scotiabank. They've had the same product for 50 plus years. Other lenders have kind of caught up with similar versions of it. Scotiabank's, I believe, is still the best. The worst on the market is out of the big banks. There's a lot of the monoline lenders who have some products that are, they have a first mortgage that's a mortgage, and then a line of credit in second position, but it's not re-advanceable in the same way. Some of them have it re-advanceable, but they're not as flexible. And then there are some that just, in terms of their capacity to pay down and move the money around, and their flexibility is very limited. And again, if you're going through this or you have a renewal, that's the time to actually look at this. If you have a 95% mortgage and you're putting 5% down in your house, less important. You kind of just, it's a CMHC mortgage, just whatever the lender's got reasonable flexibility and prepayment terms and has a good rate. That's kind of all we care about. As soon as you get under 80% loan to value, then all of this kind of stuff comes into play. It is far more important. So if you have, so the way it works is you have, let's assume this would be a $625,000 house with a $500,000 mortgage, assuming we're going to the maximum, which is 80% loan to value. So there's kind of a global pre-approved limit inside of a box, and you're pre-approved for that amount, that $500,000 global limit at all times. You get the mortgage, and then you're kind of constantly approved for that. So as you pay down the mortgage portion, the original mortgage portion you got, the line of credit portion increases until it equals the 500,000. So if you pay down 70,000, then you have $430,000 mortgage left, $70,000 line of credit. You inherit some money, you pay down another $100,000. You now have a $270,000 line of credit. Again, still totaling that 500. And once you've got it entirely paid off, you just have a straight line of credit for the entire 500. So the asterisk is annoying that I have to put it there, but the the government Department of Finance, or OSFI, I don't even remember which one now, said you can't have a line of credit on a property that's re-advanceable above 65% loan to value. However, you could have an amortizing mortgage portion of the remaining 15% up to 80% loan to value. So in a product like this, the way they've designed that is over the 25-year amortization of the mortgage, you have to have that paid down. The limit will slowly decrease to 425, which is essentially almost not worth mentioning because it's such a small amount in terms of it decreasing because it's such a long time period. That's like if you bought a house in 2002 and right now, and you bought it for 170 and you had a 140 mortgage on it, now it would be at 133. You could be your max. It's kind of irrelevant because the time value of money is going to make it an irrelevant number. It's irritating that I even have to say that because it's just gets in the way, but I have to some degree be accurate. So I wanted to put that in there. But largely, you're pre-approved for a global limit, and as you pay it down, you just continue to have access to that money up to that same limit. So strategy number one, this is the one I use and I think is the easiest to use and doesn't require you to make investments that you wouldn't otherwise be making. So you've got a re-advanceable mortgage product, as we just discussed, and assume you have the $500,000 mortgage balance. And after 1 year, it's going to be paid down to say $485, just for easy math. And you've got $100,000 to invest. Maybe that's savings, maybe you sold some stocks, maybe you sold a rental property, maybe you got some money from a relative, whatever. You've got that $100,000, you can invest it. What most people do with that is they take the $100,000 and they go buy a $500,000 rental property and use that for the 20% down payment. So now you've got a $485,000 mortgage, and you've got a $500,000 investment with $100,000 equity in it, because that's what you had to put down. So what this mortgage product enables you to do, and just kind of a proper understanding of how this all works, is what you actually do is you take your $100,000 and you pay your mortgage down by $100,000. And then you have a $385,000 mortgage. Then you immediately re-borrow it on the HELOC. So now you're back up to a total amount owing of $485,000. And then you take that same $100,000 that you borrowed, and now you invest in the rental property with it. So now so the same, if you look at the bottom numbers there, $385,000 plus $100,000, you still owe $485,000. So you haven't borrowed any more money than you're already borrowing, and you have the exact same investment. Nothing has changed. The only difference is you paid down your mortgage, you re-borrowed it. Now $100,000 of your mortgage that's registered on your principal residence is tax deductible. So this is how you get around the, in theory, I have 500 in investments. If I didn't have them, I wouldn't have a mortgage, so I should be able to write off my entire mortgage. This is basically what you do in order to get there. And the tax system is designed to encourage us to invest in businesses, to create jobs, produce for the economy, rental properties, to create housing supply for people. And that is what the incentives are for. We just have to make sure that we line it up so we're doing our paperwork properly. If you're rich people do this all the time. They sell a business, sell a stock position, take the $1 million, pay off their $1 million house, and then the next day re-borrow it and go make their next investment. So it's easy for them to do. We have to do it piece by piece unless you happen to have a big enough investment that you're selling. Yes?
Would this affect your GDS TDS?
Yeah, so there is, good question. I had to pull out the details of a lot of it because there's just far too much to go over. Yeah, okay, so will it affect GDS TDS? So yeah, so what he's kind of alluding to is that when you make the prepayment of the $100,000, when you make a prepayment on a mortgage, typically what happens is your amortization just goes down. Right? Or sorry, yeah, your amortization goes down. So you're paying far more principal. Your payment doesn't go down. So you've paid off 20% of your mortgage, but the payment doesn't go down 20%. So then you have to now re-borrow that money at $100,000. So you have actually two things that are your debt servicing now. But if you're planning this properly, what we do is we could break up the mortgage. Again, if you have the right mortgage product, some lenders don't do it, but Scotiabank, you'd have up to 3 mortgage products within the same thing. So what we do, if you know we're doing something like this, what we actually do is, instead of just giving you the $500,000 global limit in one mortgage, we break it up. So we say, let's say you knew you were going to do a $100,000 investment next year. We wouldn't just set it up as a $500,000 mortgage. We'd set it up as a $400,000 mortgage and $100,000 mortgage, or $150,000 and $350,000. So then you could actually pay when you paid it off, you pay off the entire portion of one, and then it would actually reduce your payment by the same amount. So you can just do some pre-planning around it if that's necessary. And to be honest with you, they make it harder and harder to qualify for rentals. So that type of planning is necessary. I don't want to go too much into the weeds, but yes, it does have an impact. And yeah, we just have to plan for that appropriately as appropriately as we can up front. So the Smith maneuver. This is the advantages of it. It's a proven strategy. It's fully legit. CRA auditors probably all understand it and know it. As long as you do your paperwork properly, it's a legit strategy. People do it, but it is more of a financial planner's strategy. It was designed by, or not designed. It was just he was the one that kind of promoted the Smith maneuver, which he just named after himself, really just to promote it in the industry that you could do something like this, which was a good idea. A lot of people understand this better than they otherwise would. But the Smith maneuver has anything you pay down on your mortgage, you immediately maximize out, borrow out, and then invest with a financial planner. And then you just make sure that your financial planner puts it into assets that you can rent. If you can't buy gold, for example, you can't buy crypto, can't buy RSPs with this. It won't work. Those things aren't investments. They have to be income generating investments. So you'd have to have your financial planner. So you give your money to your financial planner, and then you get a tax refund for the part that you borrow. But then you're essentially also indefinitely borrowing money. So a lot of people don't like it for that reason. And they often conflate tax deductible mortgage interest, like the strategy one, just planning appropriately to the investments you already make, with the Smith maneuver, which constantly maximizes borrowing. The Smith maneuver would have you at 500,000 total balance indefinitely. And you may be comfortable with that, but it's not necessarily something I don't like to necessarily promote and tell people to go out and max their investments. If they're going to anyways and they're comfortable with it, absolutely we want to use the tax strategy. The Smith maneuver is, it's a bit cumbersome and it's pretty paperwork intense. So let's say you do it for year number 1 and you write off, you convert 10,000, you borrow $10,000 that you invest. It would be slowly increasing over the year, but let's just assume it was 10,000 for the whole year. That same 4% would be $400 per year of interest that you could now write off at 40%. So it's $160 per year that you could write off. That's an awful lot of effort. It would actually be less than that because it would be slowly growing, then maybe 160 the next year to add to that, then 180. So it would kind of slowly increase, but at the end of 5 years, you might have saved $2,000 for this strategy. And then you decide to sell your house and move anyways, so you got to start over. So I think it's cumbersome unless you're going to stay in the same house for a very long time. And now you can also, port chunks of the mortgage over, but then it runs in, you start to run into stuff that Larry brought up, which is qualifying. If you're trying to port big chunks over, then you have two kind of mortgage balances that are hard to do. So unless you're going to stay in the same house for a very long time, you're comfortable maxing out your all of your debt, and you're comfortable handing it off to a financial planner that's largely going to do it for you. I don't particularly love this strategy for those reasons, but again, it's a well-known strategy and it is fully legal and just has to be done properly. The other thing, actually, I'll talk about interest as well. This would be all 3 strategies would have the same impact. There was a time when I executed this, bought a few rental properties using the strategy that I talked about, meaning I had enough money to invest, sold a couple of properties, just had enough built up in my accounts. So bought some properties, but again, paid down my mortgage first, re-borrowed, bought the properties. And at one point I had, basically almost $300,000 I'd converted over. Only had a little bit left of my original amount. But the rates were so low at the time. The line of credit interest is typically prime plus half. That's generally, now and again, you can get a discount or a promo or something, or if you're a doctor, you can often get prime plus a quarter or something, but generally it's prime plus half. But at that time, I could get a mortgage rate at prime minus a full percent. And at that time, interest rates at the banks was 3. So I'm taking my prime minus the 3% bank interest rate 2. So I have a 2% mortgage and I'm paying that off and replacing it with 3.5% line of credit interest. So it's kind of pointless. It washed out to being equal, except that I know rates aren't going to be that. I still did that because knowing that I've now converted that money over to tax deductible and at some point it's going to renew. The other advantage with Scotia Step product is that once I had that 300, that was kind of the last big chunk that I had that was remaining. I just called Scotia. You could do that after 1, or immediately you could have up to 3 products, as I mentioned, in their Step product that are loans or mortgages inside that kind of umbrella of 500. But I just called them and said, hey, I want to convert my line of credit into a mortgage. So they just did it on the phone with them, convert it to prime minus 1%. So immediately just got the same rate, but now it's all tax deductible. So the line of credit makes it a little more fluid, but you don't have to leave it in a line of credit indefinitely. Now, with some lenders, you do. They don't have the ability to actually lock it in. And that's why it's important to make sure that you're planning this appropriately with the mortgage product being the right step, or the first step. Cash damming. So this is the one that is being promoted a lot lately. It's in the last 6 to 12 months, you just see nothing but YouTube channels on mortgage brokers, real estate investors, everybody talking about cash damming. So it's basically the same thing as the Smith maneuver or what I'm discussing in theory, right? You're just converting your non-tax deductible principal residence interest into tax deductible interest. But I'm going to go over it and tell you what, then I'm going to tell you why I don't particularly love it. So you take 100% of your rental income. And so normally, what you do is you Let's say you make $3,000 a month in rent, and you have $2,500 a month in expenses. So you would have $500 a month left over. So you could put that down on your mortgage if you want and reborrow it if you want to invest. But what they the proponents of this say that you do, you just take the $3,000, you take the entire $3,000 and you pay down your mortgage with it. And then you take it opens up your line of credit, and then when your expenses, so your mortgage interest, your insurance, your taxes, all that kind of stuff comes due, then you use your line of credit for that. So you put 100% of your rent and you pay down your mortgage with it, and then you actually, instead of using the rent to cover all your expenses, you use a loan to cover the expenses. So you could obviously see how this aggressively, so now at $3,000 a month, $36,000 a year, you can pay down your mortgage and reconvert that over. So you could do it at a significantly faster pace. Let's say you decided to use an Airbnb for this. You could do, let's say you got $10,000 off the Airbnb for a property, $10,000 in income, but you got to aggressively market it, pay management, cleaners, everything else, and you have $9,000 worth of expenses. You're not necessarily making any more money, but you have more money flowing through your property. So $10,000 a month, $120 a year, in a matter of 4 years, you could pay off your entire mortgage and then cover all your expenses with it, which is essentially the same expenses. But you basically could convert your entire mortgage over to now tax deductible interest using this strategy, or that's what the proponents say. And technically, you can do that. There's nothing to say that you have to use rents to cover expenses first. So you can technically make all of these transactions. But there's something that just feels wrong about the fact that you're only going to be, in that scenario, you've only made $40,000 or $50,000 of profit. So you're only paying Revenue Canada based on $40,000 of income, and yet somehow with that $40,000 or $50,000 of income, you've managed to pay off your entire $500,000 mortgage. So that's why that's why I went into this thinking, okay, I got to figure out how none of the transactions in themselves violate the tax code, but there's the general anti-avoidance rule. And I tried to apply it and I couldn't. So I think this strategy is actually a strategy that works. But something about it still feels off to me. So the things you need to watch out for this strategy, one is you're going to have a CRA auditor. You're almost certainly going to be audited. And they're going to try and catch you on every little possible thing that they can. Because it just doesn't seem fair that you could have $50,000 of income and yet pay off a $500,000 mortgage with it and then replace it with now tax deductible $500,000 worth of investments. So you have to be okay with that higher level of scrutiny for CRA. You're going to have to pay for some software or be such a spreadsheet nerd and you love this stuff that you're going to be spending a lot of time making sure you cross your T's and dot your I's because they'll likely catch you. Yes.
Are you not depreciating, but writing off the expenses and also writing off the interest?
Yes. Also, so your gut instinct is probably the same as mine. It's like, wait a second, you can't do that. Like something just seems awful. You're writing off the mortgage interest. So what Larry's pointing out is that you're writing off the mortgage interest because you're allowed to write that off. But then you're making payments on the mortgage interest with a loan. And then you're again writing off the interest on that loan. Now you can only do that once. You can't layer that. It has to be, the loan can only go one deep. So you can only do it once. So you can't continue to layer it out forever, because that was one of the points I was going to make to disprove this, because you could essentially do it so fast if you just had enough loans. But there is a restriction on you can only do it one layer deep. They cannot force you to use your rental income to first cover your expenses and only use the rest. They can't tell businesses what to do. So that's, essentially it's the reverse of the if-then scenario. So an auditor can't come to, even if they wanted, if I was an auditor, I'd want to come in and say, if you wait a second, you have $3,000, of rental income, you should be paying off your $2,500 of expenses, and then only $500 you can pay down your mortgage with or use for personal use, right? That feels like, from a gut instinct standpoint, that seems like it makes sense, but that's just not how That's not how it works, because there's no what ifs. The what ifs work both ways. In this case, it's working against CRA. They can't force you to do it, and they can't say, well, you should have used this money for something else. That's not what I used it for. I used it for a legal purpose, which was I can do whatever I want with my income. And then I can also use a loan to cover expenses on a business, legitimate use. So there's no transaction in here that's actually violated any of the tax rules. Also not violating the general anti-avoidance rules. Again, I still don't like it because something feels off about it. You're going to have extra CRA scrutiny. And then it's kind of the same thing with there is also the element of it's a lot of extra paperwork and you have to be extra careful. So you got to buy somebody's software, or again, be a spreadsheet nerd and spend an awful lot of time every 2 weeks or every month doing the calculations. Yes.
I'm new to real estate investment.
Okay.
My question could be like a novice question. It's the previous page when you said you take all your income to pay $3,000 income to pay your rental, your
Mortgage down.
mortgage, and you take LOC to pay off the
All the expenses.
all your expenses.
Yeah.
So how do you pay the LOC? How do you pay back the LOC?
The one that you're building up. Well, you would have less mortgage. You'd still have to actually cover that, which is one of the wording. So the question is that, well, you still have to pay. Now you have, well, remember at the beginning, it's only $3,000 in the first month, and then it slowly grows. So essentially you'll run into that issue where you've got the mortgage, and then you've got a line of credit, both of them which you have to make payments on, and the line of credit, of course, will be growing. So you do have to make sure you have consistent income and enough of a cushion. If you really want to do this, there's a mortgage product out there that works well for this. Again, I just don't like the strategy, but I have to be honest, if you really want to be aggressive, I don't think it actually breaks the laws as they're set right now. So yes, you would eventually have to be making the payments on both. And then if yes, yeah. So you technically you'd have higher payments, but of course you would still also getting a tax refund at the end of the year, so it would help you make some payments as well. Yes, Richard.
How does this kind of compare to like the Manulife One program?
Well, the Manulife One program is a mortgage product, which is a product that would make this easier to manage because of the way they break up their mortgage. I don't want to get into the details of how that product works because it'll take up an hour, but there is products that would help you help you facilitate that. That would be one of them. You could essentially save some stress and headache on your spreadsheet or software, or whatever you're going to do to use this. Because there are proponents out there that actually just say, hey, I'll build you all the software for it. We have tax accountants and tax lawyers on staff to make sure you're doing it all properly, which at a bare minimum, if you're going to do this, you need to do that part of it right. And again, I don't love the strategy, so I'm not going to build out that software, but there are people that can do it. So yeah, one of the things is inconsistent rental income. So that leads to what your question is like. You're going to get into a position where you might end up having higher payments than your tax refund doesn't come monthly; it comes at the end of the year as well. So the other thing that I mentioned is the last one, and this is a story I'm going to tell about. It's Telus Bell and the Halloween massacre of 2006. Most people in here are probably too young to remember this, but in the early 2000s, so everyone's heard of a real estate income trust, or a REIT, R-E-I-T. Most people in here probably have. Boardwalk REIT, there's a lot of different REITs, commercial REITs out there. And the real estate income trust. So it's like investing in equities in the stock market, but there's a different type of share structure that has some tax advantages, really capital intensive upfront, and then it pays out over a long time. It's the same way real estate does. So that is so oil and gas companies said, hey, especially the oil sands where they have 10 years of upfront expenses with zero revenue and then 50 years of revenue with less expenses. So some of the oil and gas companies started doing that too. And it kind of made sense that they would start doing that. They had some of the same kind of upfront capital costs and kind of long-term investment horizon. So they started doing income trust at oil and gas companies. And then what happened is Telus and Bell one week said, okay, we've spent a bunch with their lawyers. we have the right to do this. Like there's nothing to say that one company can do it and another company can't in the tax code. We are switching over and we are becoming an income trust. Within a couple of days, the new Stephen Harper government at the time, Jim Flaherty, the finance minister, they announced, I believe on the 30th of 2006, that they were putting a stop to it. And they're saying, no, unless you're a real estate company, and these are the parameters, income trusts aren't allowed. And that's when there were billions of dollars by the 31st of that year, which is why it was called the Halloween Massacre, billions of dollars worth of the capital just exited the values of oil and gas companies, just tanked across the country. It didn't last forever because they're still the same company, just a different tax structure, but money left a lot of people just left their investments. It was a huge and significant drop in values of those shares across the board. So the answer is that just because it's legal doesn't mean Revenue Canada is okay with it. And sure, a couple of small oil and gas, oil sands companies were doing it, no big deal, right? There's been a few hundred tax lawyers doing this for years, and their friends, maybe a few thousand. But now over the last 6 to 12 months, everybody's talking about it. Most people have probably heard of it, or there's a lot of people just talking about how to do it, talking about the strategy of it, and it is apparently legal. Again, I'm not a tax expert. My hope is that it almost isn't illegal, but yet it kind of is. Or at least on the research that I could find, I couldn't find a way that it's currently illegal. But now, so if a few thousand people are doing it, and then half of them get caught because they don't do the paperwork right, not a big deal. It's not costing the government any money. However, if a few 100,000 people start doing this, and it starts to cost the government billions of dollars in tax revenue on something that really shouldn't be done in the way that they're doing it, it really shouldn't be able to have $50,000 of income and pay off a $500,000 mortgage with it, and then replace that with now tax-deductible interest. So what's likely going to happen if it becomes successful and people start using it, which is, I think, starting to happen, then the government's just going to change the law. They have the right to just say, oh, we're not going to do this for small real estate anymore. Like the government can do what they want. They can make us stay at our homes for 2 years and wear masks for 3 years. They can change the rules around tax damming once it becomes successful. So now you've set up your mortgage, you've paid for this software, you're doing all this stuff, and then a year and a half in, they're going to take it away anyway. So I think that's a relatively reasonable possibility that they are going to do that. At this point, there's nothing stopping it, but they could just change the laws if people start more widely using it, which I think is now starting to happen. So that's, again, not currently an illegal strategy, but not my favorite one. Smith maneuver, again, a fully legit strategy that people have been doing for years, but you have to max out. You're constantly maxing out what you're borrowing, and then it's really paperwork intensive for at least the little upfront benefit that you get from it in the first few years, but compound over a long enough time. If you're going to stay in the same property and you're not a real estate investor, for example, then it might be a good strategy for you. But the first strategy, just understanding how the tax rules work and making sure that you pre-plan out with a little bit of forethought how you move money around when you're going to buy rental properties and have the right mortgage product. That is by far, I think, the best strategy, especially for those of us who are real estate investors, because by the time you take the time to go through the hassle of structuring it, you're doing it at $120,000, $150,000 chunk for the first down payment. So it actually becomes a big chunk of money that you're actually doing. So you're going to save a couple $1,000s in the first year and then ongoing after that. But if you take a look at the $8,000 a year and $500,000 mortgage, $8,000 a year, every single year indefinitely, of course, that will slowly dissipate as your mortgage would be slowly paid off as well. But that's a significant amount of money over a 15 or 20 or 25 year period, especially if you reinvest that with some time value of money. It's hundreds of thousands of dollars to make sure that you fully understand this if you're already making investments in either real estate or eligible stocks that are non-RSP stocks, or your brother-in-law or sister-in-law's business. Like, it doesn't matter what you're investing in. If it's tax deductible, the interest would be on it. Just make sure that you're appropriately doing your tax planning and make sure you have the right mortgage product. One of the times to review this as well is at mortgage renewal time. So if you're already if you have a mortgage renewal, the last, like you bought it, 5 years ago, any mortgage renewal now coming up, you're going to have enough equity to be at 80% loan to value. So you could already get one of these products. And if you think that in the next 3, 4, 5 years, you might start investing, then this is kind of the time to make sure that you get into the proper product so that when the time comes, you have the ability to take advantage of the tax code as it's written. So this is a lot of information. I started with a 6-hour presentation that I really had to condense down, and decided I wasn't going to go into any details of process. And I was only going to give the higher level view to show the importance of it and how the impact that it could actually have on your finances. If you want to retire 5 years early or just wealthier when you retire, this is one way to start accelerating what you're doing. Just makes sense to have it. Those same products are really good for, access to funds for qualifying anyways as a real estate investor. So it would largely be something I would probably talk most people into being real estate investors. But if you have this in mind as well, it just helps out. It can help you save an awful lot of money. This stuff is relatively simple outside of the more complex strategy, the tax stemming. Most accountants are going to understand how this works pretty easily. And again, fully recommend that anything we discuss, I would say review it with your accountant prior to actually making any moves. And if you have questions about this, that's my email there. Send me an email. And even if your brother-in-law works for BMO and the whole family would kill you if you didn't use him, but he doesn't necessarily understand all of this, you could still feel free. I don't mind having a 20-minute phone call with anyone. I love real estate investing. Myself, Anthony, Santosh, we're all real estate nerds. So call anytime if you have questions, email. Any other questions, actually? There probably could be 1,000 questions. Yeah, go ahead.
The line of credit on the cash stemming, the interest on that
Sorry. Yes. So if you borrow money to pay for business expenses, the money borrowed can be tax deductible. Again, one layer deep. You can't then borrow money again to pay for the interest on that loan, but the original loan can be used to pay, or a loan can be used to pay for an interest expense on another business, even if that already has a mortgage component to it.
And the mortgage that you try to pay off, there is usually a penalty because it's a closed mortgage and you're trying to pay it off earlier. Is that penalty or the interest they charge taxable?
Yes, it would be. So if you are paying a penalty, so again, one of the reasons like Scotia, that $100,000 scenario, I said, if you have a $500,000 mortgage, you can pay off $100,000 with no penalty. It's 20% prepayment privilege. You can't necessarily get that in the branch, but if you have a broker that works a lot with Scotia, you can get 20% prepayment privilege. Again, the big blue bank that I won't mention because it's a negative comment, that only lets you pay off 10%, but it's really zero because they force you to do it only on an anniversary date. But what if you want to buy 2 months after your anniversary date? You got to wait 10 months to buy a rental property. Like it just, you need more flexibility, which is again why the right product is important.
I think you probably answered it, but just to confirm. So when you have a mortgage, right, it has the principal and then interest portion. Right?
Correct. Yes.
And then usually people have like a fixed monthly payment. It doesn't matter whether you are paying off your principal or not, right? But then that means like when you're borrowing money based on the amount you are putting in, your monthly mortgage is keeping the same, but then you still have that, you now have the line of credit interest you have to pay. So you're kind of paying more in a way.
Yeah, you're making hard. So that was Larry's original question. So the question was, as you make a prepayment on the mortgage, when you make a prepayment on a mortgage, a lump sum prepayment, your mortgage doesn't necessarily, your mortgage payment typically doesn't go down. It stays the same, and then your amortization is reduced. So then you still have to make the same payment that you were originally making. But then in addition to that, if you borrowed $100,000, now you have to make the interest-only payment on that $100,000. So that is something that we have to take into consideration. If you make $350,000 a year, and you're buying your third rental property, no big deal. Doesn't really matter. But like most people, it's getting, like even myself, it's getting really hard to qualify for mortgages that lenders are making it harder and harder. So debt servicing does count, which is why I suggested a solution to that is to break up the mortgage originally into components so that when you're paying off a lump sum component, that you pay off the mortgage that then actually erases that part of it. So if you break the mortgage, the $500,000 mortgage payment into 400,000 and 100,000, essentially you'd have the same total payment as a $500,000 mortgage. You'd just be broken into 1/5 of it would be on that 100,000. So when you pay that off to free up the line of credit for the upcoming purchase, then that entire amount, once you pay the entire amount off, that mortgage is now zero. So now you still have the 80% payment to go along with the 80% mortgage that you still have left. That requires a bit of foresight and planning and probably some luck involved in it as well, but we can do a little bit of that pre-planning. Doing it that way does then mean, because each of those mortgages only then has the 20% component to it, so then you're only allowed to make 20% of the 100,000 you're paying off, so that there would be a bit of a payout penalty component to that. But again, comparing that to the tax savings, is going to be complete, like it's going to be peanut, especially if you have a variable rate mortgage to minimize, which I would recommend, especially if in that portion of it, you would want to make sure that, so you'd have a 3-month penalty, you'd have to pay a little extra on that, but you'll easily save that in the tax savings within a year or two. And then again, ongoing for the remaining 20 plus years, year amortization, hopefully less, but it would give you that tax savings immediately. So again, all things that are going to be specific to an individual. If someone has no problem qualifying, not a big deal. If someone's really tight on qualifying, which more and more of us are becoming tight on qualifying, because lenders are just making it harder, that becomes important. So we have to plan ahead a little bit. Again, at renewal time, you're going to buy a rental property in the next few years. Okay, let's break up your mortgage so that when you make the lump sum, your payment goes down too. Any other questions? All right, I think we're good.